Good morning.
Good morning.
Good morning. Good morning, Doc.
Well, we're getting down to the final home stretch here. Okay. Just to recap. Let's try that again. There we go. We have 3 chapters. Chapter 10, which was the cost of capital. Chapter 11. It was entitled Basics of Capital Budgeting. Really, it was Capital Budgeting Methods. And finally, today we'll get into chapter 12, which is capital budgeting cash flows. I followed these in the order the author does, so I honestly think it would have been better to cover chapter 12 than chapter 11, but with chapter 10, we found the expected rate of return we need for the project to be acceptable, the hurdle rate. You know, for instance, if the WACC was 10%, then a project's expected rate of return had to beat that to be acceptable. Then with chapter 11, we looked at 4 capital budgeting methods. Once we have the project's cash flows and its WACC, we use these methods to come up with a thumbs down or a thumbs up for each project. And we have different methods because they profile the project differently. The NPV gave you an indication of what accepting the project would add to collective shareholder wealth. The IRR and the MIRR gave you measures of expected rate of return. Now we're going to back up with chapter 12 and actually see where we come up with those cash flows. So, there. Project cash flow estimation and risk analysis. We do very little with risk, but it's part of the title. In fact, we do nothing with risk in this chapter. We basically are trying to come up with project cash flows. And first, we have to have a definition of incremental cash flow. We're looking at the change in cash flow if we accept the project. Excuse me 1 second. Having a software glitch. Give me 1 second and I'll fix this. I know what's going on. The timings. I'm having trouble looking at this because I have a bar you can't see hiding this screen. There we go. There, that did it. Can you see chapter 12? The first slide. Can anybody?
I do.
Cool. Okay. Back to where I was. We define an incremental cash flow. And that's what we want. As the timings are coming back. Sorry, guys. My software is misbehaving. Slideshow. Shouldn't be showing any timings. Okay. Fine. All right. We define the incremental cash flows that we're looking for as the cash flows for the whole company with the project, less what they would be for the whole company without the project. That may sound complicated, but the point is delta means change. So if we accept the project, how does the company's total cash flows change? You do the same thing. If you're making $50,000 in a job and somebody offers you a job that pays 70, what you focus on? You focus on that extra 20, the change. But to make this job more palatable, we're given a lot of information. We break it down into 3 segments. The initial outlay, that would be the cash flow at time 0. Then your annual operating cash flows, and this would depend on the life of the project. If it were a 3-year project, then that would be flows for years 1, 2, and 3. And finally, when we shut down the project, that would be our extra cash flow in that final year. If it were a 3-year project, that would be the cash flow in year 3. Now, to recap this quickly, the initial outlay. If we invest in a project, we're going to have to buy some equipment. And that will occur at time 0. Annual operating cash flow are actually the annual cash profits. And then at some point, we're going to shut the project down. So the terminal cash flow would be what's left that we haven't accounted for. Now, first, I'm going to give you a ton of information. We're going to look at 1, 2, 3, 4, 6 slides of information. Then we'll go back and attack it using these 3 segments. Enoch.
Yes, sir.
Would you mind
Okay.
muting your microphone? I'm getting a lot of background information, and for some reason, I am unable to mute it. Okay, thank you. All right. So we're looking at a basic expansion decision. For this new project, we need to buy some new machinery that would have a total cost of $100,000 installed. And this new project would add $130,000 of sales. It would incur $40,000 in cash operating costs each year. And we would depreciate it as 3-year property. Now, like I said, you won't keep track of all of this. I'm going to write it up in a second. Because the new machine will have us producing at a higher level, we've not only got to buy the equipment, we'll have a higher level of inventories we carry in stock, a higher level of receivables because we sell on credit to our customers, and a higher level of accounts payable because we'll buy more goods from our suppliers. We expect to run this project for 3 years, then shut it down, and we believe the equipment at the end of 3 years can be sold for $35,000 before we consider any tax effects. Any additional earnings that our company generates will be taxed at a marginal tax rate of 40%. Your marginal tax rate's what's relevant in decision making. If you add more income, you want to know what rate will be applied to that additional income, and that's your marginal tax rate. Some people loosely refer to the marginal tax rate as your tax bracket. If you're in a 40% tax bracket, that means additional earnings would be taxed at a 40% rate. We have determined that the cost of capital for decisions like this is 15%. a marketing survey that cost $10,000 was conducted to come up with these sales estimates. That $10,000 has already been paid and expensed for tax purposes. And we've determined that this new project, the products and services that it generates, will not impact the sales of other products and services sold by MT Corporation. There'll be no cannibalization effect. You know, if we sell more of this product, it won't cause us the sales of other products to drop. So we start with step one, the initial outlay, the first segment. This, as I said, that's the cash flow that occurs at time zero. If we accept this project, if we go ahead with it, what will we have to pay right up front? Well, obviously, one thing we'll have to pay is the cost of the equipment installed. And notice that's, I'm showing a negative number as parentheses. That'll be an outflow. We'll pay out $100,000 for the new equipment. But we'll also have an investment in working capital. We'll have another $5,000 in receivables, another $20,000 in inventories, and another $15,000 in accounts payable. Working capital is defined as current assets minus current liabilities. So we'll have a $10,000 increase in working capital. A question, though, is if you have an increase in working capital, is that an inflow or an outflow? What if the only thing we had was inventories? What if this were the only item? Then the increase in working capital would be $20,000. If we bought more inventories, which way would the cash be going, in or out? It'd be going out. So an increase in working capital is actually a cash outflow. So we not only would pay $100,000 for the equipment, we would have to invest a net amount of $10,000 in working capital. So our total initial cash outlay would be $110,000. And that would be our cash flow at time zero for this project. It's an ugly zero, isn't it? Ta-da, we're 1/3 done. We finished the first segment, the initial outlay segment. Now for the next segment, which are the annual cash operating flows. What we want to do is express every item that lands on the income statement in after-tax form. And skip this for the moment. One thing we would have is additional sales of $130,000, but that's before tax. In a sense, the sales would be taxable. So if we multiply the increase in sales by 1 minus the tax rate, that would actually generate an after-tax cash flow of $78,000 for each of the 3 years of the project's life. Likewise, we'd have an increase in cash operating costs, $40,000 out each year. But operating costs are tax deductible. If you pay more for labor, you actually get to lower your taxable income. To figure out what that operating cost cash flow would be after taxes, you multiply it by 1 minus the tax rate. So for each of the 3 years, we would generate additional sales, which after taxes would generate profits, cash profits of $78,000. We would incur operating costs for each of the 3 years of $40,000, but after the tax savings, that would cost us $24,000 a year in cash costs. And then finally, we would depreciate the equipment. Now, this is from 3-year MACRS property, and it's the only depreciation schedule you'll see on your final exam, and these depreciation figures will be given to you. But this is MACRS 3-year property, the schedule. And basically the schedule says that we can take a little over 33% of the cost as depreciation. So if we multiply 100,000 by this percentage, our depreciation expense in the first year would be $33,330. If we do the same for each of the other years, that gives us what our depreciation expense would be for each of the 3 years of operation. But depreciation is a non-cash expense, but it is tax deductible. So it produces tax savings. So we would multiply each depreciation expense figure by our tax rate to get our tax savings from the depreciation deduction. And of course, a tax savings is a cash inflow. If you're in a 40% bracket and you get to lower your taxable income by $33,330, that means you pay $13,332 less in taxes. So if we throw this all together, there are our after-tax sales revenues. There are our after-tax cash operating costs, and of course, our depreciation tax savings for each of the 3 years that we operate. If we net all this out, those are our operating cash flows for each year. So we're 2/3 done. But before we move to the terminal cash flow, see this operating cash flow for the first year? Let me show you a different way you can arrive at it. Instead of taking each item separately and expressing them in their after-tax form, what you could do is create an income statement for each year. Now, this would be for the first year, year one. With an income statement, you start with sales. We expect the project to generate another $130,000 in sales. Incur $40,000 in operating costs and incur depreciation expense of $33,330. Now, in an income statement, you deduct depreciation expense. So if we take the 130 minus 40 minus 33,330, we get taxable income of 56,670. In an income statement, the next thing we'd knock out are taxes at a 40% rate, and that gives us book profit. Net income is book profit. To convert book profit to cash profit, you look up in the income statement at any item you deducted that was not a cash deduction, such as depreciation, and you add it back in. So if we add back in depreciation, this is another way to get our operating cash flow for year one. Basically, you construct your usual income statement and then add back depreciation. And that gives you cash profit for year one. Any questions before I move on? I know this is a lot to absorb. The final segment we have is the terminal cash flow. We're going to operate this factory for 3 years and then shut it down. What will we do when we shut it down? We'll sell off the equipment and we'll recover our working capital investment. That is, whatever we invested in inventories, we'll sell off. Whatever we had invested in receivables, we'll collect. Whatever credit we got in accounts payable from our suppliers, we'll pay off.
What does SV stand for?
SV, salvage value.
Oh, okay.
Value. For example, what is it we think we can sell this equipment for at the end of 3 years? Wasn't the salvage value before taxes $35,000? Right? But that was before we considered tax effects. Our federal government is kind of funny in a certain way. If you sell a depreciable asset at its book value, our government says no harm, no foul, no tax effect. But if you sell it at above book value, you have to pay taxes on the gain above book value. Now, one of the ways to get book value is you can take the original cost and subtract 3 years of depreciation. That's what they taught you in accounting. But another way to arrive at book value is to calculate untaken depreciation. If you look back at slide 11, in fact, let me go ahead and take you there, see if I can. Cool. This is 3-year property, the depreciation schedule. You know what's so funny about it? It says 3-year property, but how long does it take you to fully depreciate it? 4 years. Well, we're going to depreciate our property for 3 years, our equipment rather, and then sell it. So how much depreciation is untaken after 3 years? 7.41%. So if we go back to that slide, we could find book value, and this is actually at the new equipment. This is book value in year 3. It would be untaken depreciation, which is 7.41% of the original cost, or 7410. At the end of 3 years, the equipment will still have a book value of 7410. Yet we think we can sell it for way above that. So we're going to have a taxable gain. We're going to be selling the equipment at over $27,000 above its book value. We'll have to pay taxes on that gain. And at a 40% rate, that would incur taxes of over $11,000. So the salvage value, even though we're going to sell the equipment for $35,000, the government will swoop in and take over $11,000 of it in taxes. And that'll leave us with an after-tax salvage value in year 3 of almost $24,000. So at the end of the project's life, when we shut it down, from selling the equipment after we've considered the taxes, we'll have an inflow of almost $24,000. But we'll also recover our working capital investment. Your author and I, for simplicity in all of our problems, we assume whatever the working capital investment was at the start, it's recovered here at the end at cost. If you recall, in the initial investment at the start, we had a $10,000 outflow for working capital. So here at the end, when we recover it, we have a $10,000 inflow. So we'll have a total terminal cash flow. Think of that as an extra cash flow at the end of year 3. So for our whole project, we'll shell out $110,000 at time 0. We'll have cash operating flows, or in other words, cash profit in years 1, 2, and in year 3, we'll have cash profit, but we'll also have that terminal cash flow. So our total cash flow in the final year will be the sum of the operating cash flow from year 3 plus the terminal cash flow from year 3. They happen at the same time, so we can just add them.
On the previous slide, the 10,000 didn't affect the 23,964, I don't believe. So would that be added to it to be
It
33,964?
should be. Thank you. You bet it should. Ah. Guys, by the way, I sent you the so-called memory aid, and I put a lot of problems in it. I know I said I wouldn't, but I decided I would. Check my math on those too, please. That was an excellent catch. Sorry. Yeah, this should be 33,946. I will make the corrections to these slides and send them out to you. I'll email them to you with these corrections. So in that final year, this ought to be 33,964. So this ought to be 93,888. And as long as we've bothered to get all the project's cash flows and we have its cost of capital, we might as well see if the project would be acceptable. So we could calculate the NPV and the IRR, and the NPV would actually be 64,558, positive 64,558. So what would our decision be? We'd accept the project because the NPV is positive. This is what we think the project would do to collective shareholder wealth. It would raise it. Questions so far? Just for grins, let's try the following problem. You guys have this in your slides, right? Let's check and see if CUD's, let's fact check CUD and see if my check figure is right. All right. The Win4 Corporation forecast Actually, let's back up to slide 23. Sorry about that. Well, not 23. I'm actually missing a slide. I've got some slides out of order. All right. Let's start with slide 26. That's the start of the Wind Corporation problem. Wind Corporation is considering a new machine that'll generate $300,000 a year in sales. It'll incur $140,000 a year in cash operating costs. The machine itself costs $200,000. It'll be depreciated as MACRS 3-year property. Wind faces a 30% marginal tax rate. What is the incremental operating cash flow for year 3? And you're given the depreciation figure for year 3. So, what are we given? And this is for wind. Incremental sales will be $300,000 per year. Incremental cash operating costs will be $140,000 a year. The equipment cost initial cost is $200,000. And the depreciation percentage for year 3 is 14.81%. The tax rate is 30%. And we're asked to come up, not with all the project cash flows, just the operating cash flow for year 3. So what we do just for year 3, what would be the difference in our sales after tax? It would be the additional sales of 300,000 times 1 minus our tax rate. And that would be $210,000. Our cash operating costs after tax would be our cash operating costs of 140. I make it negative because it's cost, an outflow. But because we can deduct that, we'll have tax savings, which will knock those cash operating costs down to 98,000. And then we'll have the depreciation tax savings for year 3. And the depreciation tax savings will be the cost of the equipment times our depreciation percentage. That would give us depreciation expense for year 3. And if we multiply it by the tax rate, that would give us our tax savings from the depreciation deduction. So the cost of the equipment is 200,000. Would be allowed to take 14.81% of that for depreciation purposes. So our depreciation expense would actually be 29,620. So we would get a depreciation deduction of 29,620. It would lower our taxable income by 29,620. To see what that would save us in taxes, we multiply by the tax rate. And that's a positive figure because it's a tax savings. If we net these out, I'm getting 120,886. This is a lot like one of the problems you'd be given on the exam. You're not going to be given a problem where you have to calculate all the cash flows for a project, but you may be asked to calculate the initial outlay or the terminal cash flow, or in this case, the operating cash flow for a particular year. For example, what if we're given this problem? When corporation is considering purchasing a new machine that costs 200,000, it would require another 40,000 in inventories, 5,000 in receivables, 25,000 in accounts payable. We're looking at a marginal tax rate of 30%. What's the initial investment? So if we look at this problem, this thing is misbehaving. Here's a blank one. What are we given? cost of the equipment is 200,000 installed. We're told we'd have to invest another 40,000 in inventory. Another 50,000 in receivables. We would incur another or carry another 25,000 in accounts payable. And we're given a marginal tax rate of 30%. So the question is,
Mr. Good, what is under the receivable?
50,000
No, but like what under like
accounts
the
payable.
okay.
Accounts payable. Technically, this is accounts receivables for that matter. I've been using a short term and just calling them receivables and payables. And what we're asked for is the initial investment outlay. In other words, what's the cash flow at time zero for this project? Well, one thing we would have is the cost of the equipment. And that would be, what, 200,000 out. But we would also have an investment in working capital. Working capital is defined as current assets minus current liabilities. So we would have another 50,000 in receivables. That's a current asset. And in inventories, another 40,000. That's a current asset. And in current liabilities, we would have accounts payable, which we think would be 25,000. These levels for receivables, inventories, and payables, those are the new levels we would carry for the life of the project. So that works out to a working capital increase of 65,000, but an increase in working capital is a cash outflow. So another thing we would have at time zero, we'd have a working capital investment of 65,000. So our total incremental cash flow at time zero would be what, 265? My check figure was wrong. My check figure said 251. It should be 265. that should have been 265. It's amazing how many math mistakes I make. Now, what do you notice? What figure we were given did we not use?
Taxes?
Tax.
The tax rate. We didn't need it. I love to refer to this as smoke. It's additional information you don't need. It's provided to see if you'll bite on it and make a mistake. Okay. Let's work one more segment of the wind problem, and that's actually on slide 23. Wind forecasts that this new machine would have a salvage value of $50,000 after its 3 years of use, and that the initial working capital would be recovered at cost. What is the terminal cash flow? Now, this was equipment being depreciated as 3-year property. So if we go back and peek at slide 14 again, just at the table, after 3 years of depreciation, how much is untaken? 7.41%. So for the Wind Corporation problem, since they're shutting down the project at the end of year 3, we'll use this to get the book value of the equipment at that time. After 3 years, this much will be untaken. So now we go back to the problem that we were looking at on slide 23. And let's work this. Okay. What are we told? We're told the salvage value in year 3 will be 50,000. And we just looked at a table and noticed that at that point in time, 7.41% would be our untaken depreciation. Sorry about all the jumping around. And from our earlier problem, the change in working capital at the start was 65,000. So now we're going to recover that 65,000. And the cost of the equipment, I'm having to piece this together. these green slides were all supposed to be in a row. When I send this back to you, they will be. But the original cost of the equipment for wind was 200,000. And wind's tax rate was 30%. And what we're after here is the terminal cash flow in year 3. That's what we're being asked to find. Well, at the end of year 3, we expect to sell the equipment for 50,000, but that will produce a taxable gain because we're selling it for more than its book value. Its book value will be 7.41% of the original cost, or $14,820. So we're going to have a taxable gain of $35,180. We'll be selling the equipment at over 35,000 more than its book value. The tax on that gain, well, it'll be our tax rate times the gain. So let's see, 30% of this gain, taxable gain, would incur taxes of $10,554. So our salvage value after tax in year 3 would be the salvage value of 50,000 less what we have to give up in taxes. Yeah, we expect to sell it for 50,000, but then we expect the government to swoop in and take over 10 of that, which would leave us with 39,446. So our terminal cash flow in year 3 would be the salvage value after tax, which is 39,446. And we'd also have the working capital recovery. One second. We shelled out 65,000 in working capital at the start, so now we recover it. And that gives us a terminal cash flow in year 3 I'm getting 104,446. And that was my check figure. Notice what we're doing with your example problems. I'm not making you work the whole thing. I'm asking you to work different parts because that's how your exam would be set up. Any question on any of this? Anybody? All right. Tell you what, this is a really good stopping point. Today is Wednesday. Monday, we'll finish off this chapter. I'll probably work another problem or two, the Loose Corporation. I'll fix the slides for this chapter, mail them back out to you with the check figures corrected. And also, I'll put them in a little bit different order so they make more sense, the problems anyway. Anything from anybody?
I had a question about, so you're making the memory aid for us. Are you going to include like the keystrokes for the calculator, or is it just going to be formulas?
Hampton, I mailed that to you yesterday. Have you looked at it?
I skimmed over it. I didn't read it in depth. Let me see.
If you look at it carefully, that'll answer your question. Well, if you give me the question again, I'll see if I can answer it. What was the question?
So you're making the memory aid for us.
Yep.
And you said on Monday you're going to include like the formulas we need. Are you going to include the keystrokes for the calculator, or?
They are in there.
Okay.
Tell you what, just take a good look at that memory aid. It's 4 pages long.
Okay.
That would be your 2 sheets if you prepared it yourself front and back.
Okay.
And what you'll want to do is print it out. And then when you take your exam, have it there to use. And just to clarify, we're not using ProctorU. We're actually going to hold a Zoom session. All of you need to have your cameras working. And I will literally watch you as you take your exam. You'll open up the Zoom session, then minimize it. Don't delete it. Don't get out of it. Then go into Moodle, click on Final Exam, and you'll be rolling. You should have already gotten the invitation for the Zoom meeting that will be your final exam. Just to check, did any of you, Haley, Joshua, Hutch, did you guys get the memory aid? I did email it out.
Yeah,
Yes,
I
sir.
did.
I got it.
Cool, okay.
Is the final going to be multiple choice, or is it going to be where we have to write
The
everything?
whole thing is multiple choice and it's long.
All right.
About a third of it are questions, roughly 2/3 problems, but all of it multiple choice. Anything else?
Dr. Cud,
Hey, Mandy.
hey, I got your invitation for the Zoom meeting, but I never got the memory aid.
You didn't get
It's
the
at the
memory
very
aid?
bottom. It's at the very bottom of the email.
Yeah.
Okay.
Scroll all the way down to the bottom past the invitation.
Yeah.
All right, I got it.
I attached it to that mass email, so yeah, click it and it'll download. And again, if you guys find mistakes in my memory aid, please let me know. I'll fix it, send it out again. All right, guys. I'll see you next Monday. Stay safe.